All right, so we saw some big upside moves in the home builders, but also companies like Lululemon and Deckers, yoga pants and sneakers. The idea of Fed rate cuts, do you see that significantly juicing the market and the consumers willing to spend on things like that?
Well, it could definitely signal that the Fed is supporting economic growth and therefore improve consumer and investor sentiment and, of course, discretionary spending. However, what's very key right now is to understand that we are dealing with a highly price-sensitive consumer that is only seeking bargains and values. And this will continue to be the case, even if if the rates come down as consumers continue to deal with high unemployment, above 4%, and also persistent inflation and rising tariffs.
All right. We've hit on this quite a few times on the show, also on the network more broadly, that the upper tier consumers, the high income earners, they're doing about half of the spending, the top 10%. So does this rate cut, does that change their willingness to spend or the areas that they are willing to spend on?
The high-end consumer continues to be engaged with premium brands. When we look, for example, at a retailer like Ralph Lauren, they've continued to maintain comps above 3%. Just so you know, 3% reflects healthy U.S. consumer spending. And Ralph Lauren has consistently been posting impressive, robust comps, whereas what we're seeing for middle-class consumer, they continue to trade down. So retailers like department stores, which are expected to report this week, they've been losing a lot of the market share and even Target to value retailers, including Walmart and TJX, who, according to our LSEG data, are very likely to continue to do very well during the next year.
Yeah, TJX in particular, not totally immune to tariffs, but, kind of as a moat against tariffs because they kind of get a lot of their products from companies that are trying to liquidate, so they kind of avoid some of that tariff impact. Speaking of tariffs, what about the furniture makers? The president signaling that tariffs could be coming for imported furniture. We saw some big moves. Williams-Sonoma, one of the biggest laggards in the S&P this morning, and other companies like Lazy Boy that produce here in the U.S. getting kind of a boost on that news. How do you view that for those group of names, the furniture makers? The idea of tariffs, is that going to be a one-time price shock that scares away consumers temporarily, or is that a significant threat and challenge and headwind to their business?
It is, and mainly because over 50% of the furniture that is imported is coming from Vietnam and China. Already the CPI data is telling us that those prices are highly elevated compared to a year ago. When we look at our LSEG data for the current quarter, the second quarter, they're expected to see a 1.7% same-store sales growth as a sector. And this is on top of very easy comparisons from a year ago. The retailers that have already reported for the second quarter, including Ethan Allen, have already been posting negative earnings growth as they struggle to match last year's level. So what this is all telling us is that continued price hikes are very likely to continue to hurt demand and sales, especially during this climate.